So today is the 3rd of November 2025. We're having a live webinar on introduction to risk management. Thank you for that feedback, Mala. Yeah, appreciate it. All right, so before I proceed, I'd like to know what category or what level of trading you are. What is your level of experience? So I'd like to know if you are a beginner, just go to the comment section and type beginner. If you are intermediate, go ahead and type intermediate. I want to know you. Let me know what level you are. Let's do that within a few seconds. Just head straight to the comment section. All right, thank you, Franny. Franny, you say you're a beginner. Another person? Mr. Ochon, good afternoon. It's been a long time. Good to see you here. Ayomekun is also a beginner. That's good. Another person? Mala is intermediate. Okay, I need one more. Beginner, intermediate. All right, Savadio is also a beginner. So we have more beginner traders on the platform this afternoon, just one intermediate. Others are beginners. All right, it's still good. All well and all good. And that's why it's good you get the foundation right. So the challenge of many traders is because they had a faulty foundation when they got into this business. And that's why one of the best ways to learn is through proper mentorship. When you follow a particular person that has experience and you are able to allow that person to hold your hand and take you through the journey of trading like you are on the platform this afternoon. And that's what we do best at PO Prime. We don't only give you the fish, we teach you how to catch the fish. All right, so let's get started. So we're looking at introduction to risk management. So what is risk management? We say that risk management is a process of limiting or eliminating different types of risk related to forex trading. Now the keyword here is limiting or eliminating. To be honest, it may be difficult to limit, to eliminate rather, to eliminate the risk associated with trading. We can only limit it. Yeah, that's the truth. We may not be able to eliminate risk at this point, but we can limit it to the barest minimum. So in forex trading, we take risk in order to make profit. Anytime you execute a trade, it means you are willing to take a risk in order to have an outcome of possibly a profit. So each time a trade is taken, the trading account is exposed to risk. Now, all businesses have one form of risk or the other, and the level of risk varies depending on the nature of each business. Some businesses are high risk while some are low risk. Now, this is just a reality about life. Any venture that will bring you profit requires a measure of risk, and trading is not an exception. Forex trading is just like any other business. It will be forex, crypto, stocks, commodities. It's not different from any other type of business. But the benefit of this online trading business is that you can determine the level of risk exposure you have each time you are entering into the market. So, excuse me. All right, so as I was saying, I'm back. So in this business, there's risk, just like any other business, but you can determine the level of your risk exposure. A business that will give you a high return may also require to have a high risk, while a business with a low risk will give you a low return. And that's what the next line says, that all businesses, however, for all businesses, however, the higher the risk, the higher the return. Conversely, the lower the risk, the lower the return. Now, the main reason why we're here is we want to know how to apply risk management in trading. See, in trading, strategy is good. It's good you have a good strategy. But sometimes you may have a good strategy, but you have poor risk management, you may still end up making losses. So we want to know, how do you apply risk management to keep your account safe? See, I always tell traders, as a trader, you have two main responsibilities. Your first job as a trader is actually not to make profit. Yeah, I know some of you are listening that, hey, what was he trying to say? Why are we doing business? Is it not to make profit? Your first job as a trader is not to make profit. Your first job, your first responsibility as a trader is to protect your account. That's your first responsibility. Now, profit is now the next thing that comes up after you have protected your account. Because If you don't protect your account gets blown up, you're out of business. So that's why your first priority is account protection, and the second one is profit taking. So the first way we manage our accounts with proper risk management is through what is called position sizing. So what does position sizing do? It helps us to determine the appropriate size of your trade and your trade position based on your account size, your risk tolerance, and your trade setup. Now, many traders don't know the percentage of the account that is exposed to the market each time. Some just place trades randomly and wish to have a good outcome because they're not properly educated, in understanding that there's a percentage of the account that is exposed to the market each time they place a trade. Now let's look at an example. If you have an account of $1,000 and you risk 2% per trade, that is $20. You will need 50 consecutive losing trades to wipe out that account. I'll repeat that. If you have an account of $1,000, you funded $1,000 into your trading account and you risk 2% per trade. Now, professionally, you are not expected to risk more than 2% of your equity per time. So 2% of $1,000 is $20. So if you're risking $20 per trade, that is a stop loss of $20 on a $1,000 account. You will need 50 losing trades back to back to wipe out that account. On the other hand, if you have an account of $1,000 and you are risking 10% of your equity per trade, 10% of $1,000 is $100. Such person needs just 10 losing trades back to back to wipe out the account. So you see that the lower the risk you have, the higher your chances of keeping your account safe. Like I said, your first job as a trader is to protect your account. So you don't need to take unnecessary risk. The higher the risk you take, in reality, the more profit you make, but the higher chances of you wiping out your account. All right. So the question now is, how do I know the type of lot size I can use per account to keep myself safe? And that is what you are seeing on the screen. You can see safe lot size with a leverage of 1 to 500. If you have an account of $100, the highest lot size you can use on a $100 account, on a standard $100 account, is 0.01 lots. That is the highest. Never exceed that. Now, with this $100 account with 0.01 lots, 100 pips will be $10, which is 10% of that account. 2% of $100 is $2, and you can only achieve that if you trade with 0.01 lots. Now imagine somebody placing a 0.1 lot on $100. That is 1 pip is equal to $1. 10 pips is equal to $10. So 10 pips, you already have 10% of your account, already exposed and about to go. So if you are trading with $200, the highest lot size you can use must not exceed 0.02 lots. For $500, your highest lot size cannot exceed 0.05. It can even be less. On $500, you can still trade 0.03 and you are still safe. See, the lower the lot size, the safer your account. Yes, the lesser the profit you make, but you see, you're not looking at profit on just one trade. You're looking at compounding profit over a period of time. All right. So if you're trading with $1,000 account, you're not expected to trade more than 0.1 lot. If you're on $2,500 account, your highest should not exceed 0.25 lots. And if you're trading with a $5,000 account, you're not expected to exceed 0.5 lots. You can even make it less. Now, one standard lot can only be used on a $10,000 account. That is a professional standard for trading. I'll repeat that. One standard lot is only to be used on a $1,000 account. So if you don't have it, sorry, you can only be used on the $10,000, pardon me, $10,000 account. So if you have $2,500 account, you are using one standard lot, you are putting your account at a serious risk. It means you are not following the principle of position sizing in trading your account. So I want to encourage you from today, make sure you apply position sizing in trading your account by just following what you are seeing on the screen, the specific lot size for each account size. That way, your account can be protected. Another way to protect our account is through what is called stop loss order. Stop loss order. Stop loss is actually a function on the trading platform where you determine the specific amount, maybe in terms of pips, on your trading account, which you're going to set as a loss meaning that in case the market goes against you, that is a maximum risk you are willing to take on that account or on that trade. Now, there are many ways to set stop loss because this stop loss, for a lot of traders, especially beginner traders, it brings a lot of confusion. Some don't even know how to set it. How do I set stop loss? Now, you see a lot of funny ways people set stop loss. Some will say every 10 pips, stop loss. No, those things don't work. 10 pips, 20 pips, 30 pips, they don't work because spread varies from one currency pair to the other. If you use a stop loss of 20 pips on Euro USD, it may work. But a 20 pips stop loss on GBP JPY is never going to work because the spread is not the same. And also the characteristics of each of these currency pairs are not the same. While the Euro USD is mild and you know most easily in the market, GBP JPY is more volatile. So because of that volatility, a fixed stop loss is not going to work for a currency pair like GBP JPY. So the question is, how do we now set the stop loss? And these are the ways you can set stop loss from what I wrote on the slide. You can use the most recent high or the most recent low to set your stop loss. So if you're selling, for instance, your most recent high can be your stop loss. If you're buying, your most recent low on your chart can be your stop loss. The same thing, you can use support and resistance. That again, if you're selling, your resistance can be your stop loss. If you're buying, your support level can be your stop loss. You can use the Fibonacci tool to set your stop loss. You can use pivot points. Now, pivot point is a good tool, but then it's not a custom indicator on MetaTrader. You need to download from third-party sites like Forex Factory and others, and now install onto your MetaTrader platform. Now, you can also use what is called the risk-reward ratio. Maybe you want to risk 30 pips or $30 in order to make $90. Let's say we're looking at a risk-reward ratio in the ratio of 1 to 3. I'm risking $20 to make $60. I'm risking $50 to make $150, and the likes like that. Finally, you can also use trailing stop as a way to set stop loss. Now, trailing stop is an automated function on the MetaTrader platform, desktop version. As at this moment, it's not really on the mobile version. At least I'm sure of MT4 is not MT4 mobile version, but you can find it on the desktop, both from MT4 and MT5. So it's an automated stop loss that trails your trade. So as the trade is moving higher, the stop loss is being shifted. There's a manual trading stop that's automated. This one is automated, and you can set it on your MetaTrader platform. So these are the valid ways you can set stop loss on your trades. Another way to practice risk management is through what is called diversification. Diversification. Never put all your capital into a single trade. Divide your trades across different currency pairs and set up in order to spread risk. So let's assume you place a trade and you put a standard lot on one single trade, Euro USD. Let's assume you have an account of $10,000, just like I mentioned earlier, and you put just a single trade on Euro USD with one standard lot. The risk is still high. Now, instead of putting one standard lot on Euro USD, you can diversify that trade. You can have maybe 3 or 4 different currency pairs that are even not related. Not related to the Euro USD. That way, you are spreading the risk because it's a 50-50. If you take a trade on one standard lot Euro USD, if the trade goes bad, you have a fraction of your capital gone. But if you spread the risk by taking about 3-4 trades from different currency pairs, if 3 of them wins, and one loses, you are still in profit. And the same thing, if all wins, you're in profit. If it is 2 that wins, 2 that loses, that's a break even. That way you can manage your account better rather than putting all your capital into one single trade. Also, you have to avoid over leveraging. Now, a high leverage can amplify both your profit and your losses. Now, a lot of beginner traders, they are only looking towards the good side of trading, the good side when they make that, big profit, when they hammer on one trade. They are never conscious of a time when things don't go as planned. Now, the truth about trading is that everything will not be going your way at all times. No, it's not going to happen that way. There will be times when you have to learn to accept a losing trade as a losing trade. It's part of trading. Don't let anyone deceive you. There will be losing trades. I always tell my students, you will have losing trades. Now, what makes you a better trader is that you have more winning trades than losing trades. And one of the ways you can do that is by what we're teaching this afternoon, by making sure you apply proper risk management on your trade. So you are encouraged to use leverage judiciously. keeping in mind that higher leverage will increase your risk exposure to market fluctuation. So never over leverage. Over leveraging can lead to over trading, which involves opening multiple trading positions, which can put your account at risk. So minimize your trade as much as possible so that you don't over leverage. Now, another way to practice risk assessment is another way to practice risk management is through what is called risk assessment. Now, this involves you evaluating the potential risk on a trade before the trade takes place. For example, we're encouraged to always check forexfactory.com every morning. If you're a trader, the first thing you do in the morning is you check Forex Factory. Is there going to be any upcoming news today? What time will the data be released? So this can help you to plan your trade. It can help you to know the potential risk of the trade you want to take. So, and you also have to check other technical factors like support and resistance. It's so funny that people are placing, buy trades when price is about to hit a resistance because they don't even understand this concept. Or some are selling around support level. No, you are selling around resistance and buying at support. So these are things you need to check out for, checking out for the proper assessment, risk assessment of your trades before you take them. Now, as a rule of thumb, you are not to place a new trade 2 hours before the release of a fundamental data. Why? Because if you place that technical trade 2 hours before that release of that data, the data may come out opposing the direction of that trade, and that can take that trade to become a losing trade. If you want to trade news directly, or better still, wait for the data to be released, like 30 minutes or 1 hour after the release of that data. Then you can now take technical trades afterwards. Now, another way we affect risk management is by combining technical and fundamental analysis. Yeah, you can combine both technical and fundamental analysis together. That gives you a clearer picture of the market, both from the technical and the fundamental perspective, giving you a higher probability type of trade, which will most likely result into a profit. Also, risk tolerance and emotional control. Now, this is very, very important. Our risk tolerance as individuals vary. You see, as a trader, you are unique as a person. You have your temperament, which will dictate how you trade. Your temperament will dictate how you trade. So you know your own personal risk tolerance. Never compare yourself to another person. Our risk appetite varies. Some people are high risk traders, while some are conservative. If you're conservative, just be yourself. If you're high risk, well, that's your personality also. So you need to understand your personal risk tolerance and your emotional reaction to losses. Avoid making impulsive trading decisions driven by fear or greed. Now, this comes under emotional management. You see, there's a section in trading, it's part of the teachings we do, which we call trading psychology. It talks about how our emotions affect how we trade. And two key areas of emotion in trading is the greed and the fear factor. Virtually all traders are greedy. That's just the truth. Many of us greed turned us into traders. But over time, you have to learn to kill your greed in order to be successful in this business. Also, you need to deal with your fear. Greed is that excessive desire for wealth. You want to double a $500 account to 1,000 within a matter of days, or even within 24 hours. That is greed. That is greed. It's still greed also. You're taking a trade on 1 hour time frame. You are waiting for that trade to go to 150 pips. It's still greed. It's greed. So as a trader, you have to learn to deal with your greed. It's greed that makes you enter a trade. The trade is going your way. You add three other trades. Yeah, thank you. Mala is laughing. It's true. We hear all these things. You see somebody enter a trade now, the moment the trade enters 5 pips profit, it dumps like five other trades to it, saying that all of them let them run into profit. That is still greed. You see, you're not thinking about what if something happens in the market and the trade turns against you. Your loss will be massive. So you have to deal with your greed as a trader, and dealing with your greed requires discipline. Discipline. You just have to be disciplined with yourself, and also fear. You have to deal with your fear. Fear comes up most times after repeated losses. You took the first trade, it ended up in a loss. Second loss. I'm telling you, after three consecutive losses, by the time you want to place the next trade, fear will naturally catch you. That's the truth. Fear will catch you. You'll be afraid. You'll be afraid. But then you have to deal with that fear. If you want to make money in trading, you have to learn to deal with your fear. You have to learn to deal with your fear. All right, let's move. Now, another way to effect risk management is using what is called backtesting and demo trading. Now, before you implement a new trading strategy, it's advisable you backtest that strategy. Backtesting simply means you're going on the charts, you're looking back in history if that strategy had worked in the past or not. So let's assume you want to implement a strategy around support and resistance. Now you can go on the charts and look through the last 5, 10, 15, 20 years. Has support and resistance been working in the last 20 years? The answer actually is yes. Now, there's a saying in technical analysis that history always repeats itself. And that's the truth. In technical analysis, history will always repeat itself. So if your strategy, support and resistance, for example, if it worked in the year 2000, it worked in 2005, it worked in 2011, it worked in 2017, it worked in 2021, it worked in 2024, it worked 2025, it means if you see it today, it will still work because history will always repeat itself. So we say when you have a strategy, back test it on historical data. You know, some people make this mistake. You just learn the strategy now. The next thing is that you put that same strategy on a live account, and something that happens, the account goes. You now say the forex is a scam. It's not a scam. There is a process to making money in this market. So before you put that money on a live account, first of all, back test. Now, after back testing, you now proceed to the next stage, which is demo trading. With backtesting, you are not trading. You are only looking through the chart. You are looking through history, if that strategy has worked well in the past or not. Then you now move to demo trading. With demo trading, you are now trading, but on a virtual account. A demo trading account is a virtual account. It's a simulation of a real account. The fund there is not real money. It's not. So if you make profit, you can't withdraw it. If you lose money, we won't hold you. Yeah, that's the truth. So the demo trading account is there for you simply to practice your strategy. You can practice as many times as possible. You know, the essence is so that you can get grounded and ensure that strategy works well before you proceed to trading that strategy live. All right. So going forward, don't always jump into trading live with a new strategy. First, back test, demo trade. Now, if you've back tested, you've demo traded, it works fine. You can now proceed to the next stage, which is a live trading. All right, the next point for effective risk management is to have a risk management plan. Have a risk management plan. We say develop a comprehensive risk management plan that outlines your approach to position sizing, risk limits, and strategies. Stick to this plan consistently to maintain discipline. One of the biggest things you need to do as a trader is discipline. You have to learn to be disciplined. To be disciplined means you stick with your trading rules. Like I mentioned earlier, if you're trading with $100, never exceed 0.01 lot. If you're trading with $1,000, never exceed 0.1 lot. Under no circumstance will you increase the lot size beyond those particular levels. So once you've determined your take profit, your stop loss levels, then your strategy. What are the parameters you're looking out for before you place a buy or sell? Probably you're seeing RSI cross above 50, MACD cross above zero, price hit a support. You know, be disciplined to stick with that trading rule. It will help you, you know, in the long term. Now you need to also understand what is called currency correlation. You know, some currencies are positively correlated while some are negatively correlated. Positively correlated currency pairs, they are pairs that go in the same direction most of the time. Not necessarily all of the time, but most of the time. For example, USDJPY, USDCHF, they are both positively correlated because the dollar is the base currency. So if USDJPY is buying, there's a possibility USDCHF may also be buying, though at different levels of volatility, but they should be buying simultaneously. Now, on the other hand, a currency pair like Euro USD is negatively correlated to USDJPY and USDCHF. So while USDJPY, USDCHF is buying, Euro USD may be selling. So it will be difficult for you to say you are generating a buy signal on Euro USD, on USD JPY, and USD CHF at the same time. That will be wrong because the correlation of the three, they are not the same. So you need to understand the correlation of the currency pairs you're trading. All right. Keep emotions in check. Emotional trading can lead to impulsive decision. Stick to your trading plan. And if a trade goes against you, don't let fear or greed drive you to taking unreasonable action. See, stop taking revenge on the market. It's never going to pay in the market. It will hurt your account. You lose the first trade, you lose the second trade, the third trade, you doubled your lot size because you want to recover. I can guarantee you, you may likely lose that trade. Again, the fourth trade, you now doubled it higher than the previous one. What if it turns into a loss again? Never take revenge on the market. Stick with your lot size at all time, regardless of what you're seeing in the market. So keep your emotions in check and avoid irrational trading behavior. And finally, regularly review and adjust your strategy. This market is a dynamic market, it's an ever-changing market, and it's advisable you regularly review your strategy. There are times when your strategy may look as if it's not working. It doesn't mean the strategy is bad, but the market condition may not be right for it. Now, this is one of the reasons why you see some traders jump from strategy to strategy. In January, they are using price action. In February, they move to SMC. In March, they move to another thing. In April, they are just jumping from one strategy. Stop it. If you are doing that, go and stop that. You will not be profitable overall. Learn one strategy and stick with it, regardless of the market condition. So what do you do if the strategy is not working? You may just need to tweak your strategy a little here and a little there. Maybe you need to add a new indicator to filter that strategy in a season when it's not working fine. For example, as you approach December, volatility will drop in the market. Some strategies may not work, but that does not mean those strategies are bad. It's just that volatility may drop in the market at that period. So always regularly review your strategy for better performance. You're welcome, Mala. All right, that's going to be the end of this webinar this afternoon. I believe you've been able to pick one or two new points that will make you a better trader. Now, if you have a question, the floor is open. You can unmute your mic, or if you're in a noisy place, just go ahead and type a question, your question in the comment section, and I will definitely respond to you. All right, so the floor is open. Let's roll. Okay, let me read the comment from Mala. Mala says, wow, I really love the way you brought out the point. Well understood. Thanks for that feedback. It's very much appreciated. All right, so I'm waiting for your question. Go ahead. Okay, Dauda, network didn't allow me to join early. Don't worry. The recorded version will be posted in all your groups. So just relax. After the lecture, we'll upload it on our YouTube channel and the link will be dropped so you can watch it. And I always encourage watch it over and over again till the information is able to sink into your heart and you can apply it for better trading experience. Okay. You talked about trailing stop loss. How do we activate it on MT5? If you don't mind, can you show us an example of the trailing stop loss? All right, so let me just take you briefly to the chart. Yes, so let's go back to that spot. Okay, just a second. I'm trying to log into my MT4. Yeah. So submitted successful. So let's go to that copy trading. Okay, so I'm switching over to MT4 now. Yes. So click on the first one by your left hand side. Okay, yes, report, yes. So investments, put where you have that investment, just put $400. So when you have that stop loss or something, put 60%, 60. Sorry, 50%, 50%. That place that it's through a red mark
or red line. Yeah, put 50 there. Yes. Now click on OK.
All right, so let's go. So I'm on MetaTrader now, MetaTrader 4. Now, if I click on new order and I open randomly, please take note this is not a signal. We are only taking lecture here, so don't go ahead and copy it. Don't do that. All right. Now, this trade has been placed now is a demo account. Now you can set the take profit and the stop loss. But then if I want, okay, let's make it. Now, trailing stop does not mean you should not use stop loss. Okay. It doesn't mean you should not use stop loss. So you still set your stop loss regardless. So let's assume I'm using a 100 pip take profit and a 50 pip stop loss. All right. So if I want to apply trailing stop, I'll highlight on the trade. I'll right click and you can see the menu trailing stop. Now it starts from 15 points. Now this is not pips. This point is not pips. So don't assume it's pips. So I would suggest maybe you can start from like 30 or 35 points. It gives some reasonable breathing space for the trade to move. If you feel more comfortable with the higher ones like 40, 45, depending on your trading goal. But if you are doing day trading, 35, 30, 35 is okay. If you are doing swing trading, yes, you may look at 45, 50 points. But for day trading, 30, 35 points is just okay. So if I'm using 35 points, for instance, I'll click on it. And you can see the stop loss is still defaults to the stop loss, but it has put it in the yellow color. Meaning, now you can see the trade is trying to run into profit. Meaning, each time the trade enters into like a 30 pip profit, the stop loss automatically. Now, the original stop loss is there, but that trading stop automatically shift the stop loss, to lock in profit. This is what I'm saying. Oh, okay. I have an analysis right here. And okay, so let me use this. Let me use this setup. I actually have a bullish setup on Euro AUD. Fine, this is just excellent. And I'm anticipating a breakout, and it's already trying to happen. I have a kind of a double bottom pattern right here. So I'm expecting a breakout. So let's assume everything is set and it's actually going bullish. It means with this trading stop, let's assume these are my profit levels. This is profit level 1. This is profit level 2. Okay, sorry, this is profit level 1. Let me use this area. This is 1. The first line, profit 1, profit 2, profit 3. What trading stop is saying is this. By the time price comes to this first take profit level, now let's assume our stop loss is somewhere around here. The stop loss will be moved from here by 30 pips above. So that way, that trade cannot lose again. It cannot lose again. If the market reverses, it will close at the entry price or at whatever level that trading stop has moved it to. So for trading stop, what it does is that it's in this manual automated one. Each time price is going higher, your stop loss also is shifting up, following the profit, giving a little space in between for price to move higher. So if price goes up again, the trading stop also moves a little higher. Again, as the price goes higher, the trading stop, which is like the automated stop loss, keeps going higher. So that way, the worst that will happen is price will reverse, and you have already closed a lot of profit below that period. So I mean below that price level. So you can't lose the trade. Eventually, you can't lose it. Even if there's going to be any movement, maximum that will happen is that you close at a break even. Yes, Sam Adu, it will be very useful for volatile pairs. That's true. So if you have not been using trailing stop, you need to start using it, especially if you trade on the desktop. That's the advantage you have trading on desktop. You can use your trailing stop. Okay, how can I calculate my risk reward ratio before entering a trade without using biro and paper? Very good question. All right, let me use this trade on the screen also. So let's assume You're looking just randomly. This is Euro AUD. It can be a bit volatile. So you may decide, okay, because it's a volatile pair, you're looking at a profit in the range of 50 pips for your take profit. Sorry, you're looking at 50 pips for your risk. Yeah. So your reward will be times 3 of that. For a volatile pair, 50, especially if you are doing swing trading, 50 pips is okay for Euro AUD. If it's day trading, maybe 30 pips. So if you're looking at 30 pips, as a risk, then the reward should be times 2 or preferably times 3 of that amount. So if you're looking at 30 pips for risk and you're looking at times 2 of that for the reward, that'll be 30 times 2, that'll be 60 pips for your profit. And if you're looking at a ratio 1 to 3, you're looking 30 pips to make times 3, which is 90 pips. So that is how to set risk reward ratio. You need to know the currency pair you're trading, the characteristics, and the volatility. That will guide you. Dauda, can I use this on all pairs? What do you mean by this? You mean the trading stop? Like I said, if you're using trading stop, it works on desktop. It works on desktop. It doesn't work on mobile. So please take note of that. It works on the laptop, not on mobile, not on phones. Oh, Chong, I'm always happy with your lecture. Thanks. Thanks for that feedback. Wow, wow, wow. Okay, let me read out this. Let me read out this comment from Fortuna. Forest was introduced to me in a wrong way, but you changed my view within weeks. Thanks for that. Thanks for that. That's why you have to just keep joining us at PU Prime. And I don't know where you're based, but if you're based in either Lagos or Abuja, I want to invite you specially to our training academy. We hold training sessions twice in a week, Tuesdays and Thursdays. So join us for a physical session, and I tell you, you will not regret it. You will love to trade. You'll know quite a lot of things within a short period of time. So try to join us for those physical session. Okay, I think I've attended to. Oh, okay, rejuvenate. All right. All right, that's a good one. That's a good one. Okay, I think I've attended to all the comments and the questions right here. Like I said, for those who joined us late, just make sure you join. I mean, make sure you watch out in your WhatsApp or any of the PU Prime groups that you belong to. Because in those groups, I will drop the link to the recorded version of this video so they can watch it over and over again. Don't get tired of learning. See, the more you learn, the more you know. That's the way the forex market works, you know. All right, so we're going to be ending this training session right here this afternoon. If you're on PU Prime, you're on this session this afternoon, you don't have an account with PU Prime, then go ahead right now, reach out to me in my WhatsApp. I will guide you through how to open a live trading account. If somebody has reached out to you from PU Prime, then contact that person. But if you're on the platform this afternoon, nobody has reached out to you, you don't know your account manager, you can reach out to me. All right. So we end the session right here. Take care and have a great week ahead. Bye bye.